So I really got interested in the whole world of finance and investing when I was at Northwestern in my undergrad career. Took a course called Money and Banking with Professor Mark Whitty. I'm still in touch with Professor Mark Whitty today, and he really set me on a path to first think about the whole world of finance, which I wasn't aware of before then, and all the different aspects. And so encouraged me to go into investment banking, and so started my career with Bear Stearns in New York. Worked with Bear Stearns as an analyst, finished my analyst career, and then actually went to work for a company, thinking that maybe a CFO route would be an interesting one. Quickly learned that that was not the route for me, and I was much more interested in the prep for the board meetings and attending the board meetings and what was happening sort of at that level with the investors that were in the company. And so started to think about getting to the other side of the table from that perspective. But I worked for a company in the internet age in 98, 99, 2000 called IXL, and we started a venture arm, IXL Ventures. It was a time when everyone was starting venture arms, and it was an internet services company, and we felt like we were seeing companies early. So I spearheaded the division of IXL Ventures, and then over time we lost a lot of money during the boom and the bust. But I had the opportunity to go back to business school, and so went to Harvard, came out into knowing exactly what I wanted to do, which was invest in companies, high growth companies, but later stage. And so joined Summit Partners as a vice president in 2002. Yes, I had the benefit in 2002 starting to come out of the recession, where we were investing at a time where prices weren't terrible. They were reasonable. Of course, our older peers thought that wasn't the case, and the companies seemed expensive to them when they had been investing at 5 to 6 times EBITDA, and now we were investing at 7 to 8 to 9 times EBITDA. But today, we've only sort of seen those numbers go up, right? And so at some point, maybe, generations have to retire. But that's been the biggest difference, really, from '02 to today. I'd say, multiples have only gone one direction. And even during the recession, on the later stage companies that have reached profitability, they just choose not to transact during a recession. So and the only reason to transact during a recession is if you need capital, if you need cash, and then beggars can't be choosers. But in the case of companies that are profitable on a day-to-day basis, they just wait out the recession. So you don't tend to see a dip as significant in valuations on the later stage growth equity side. Yeah, I think you're starting to see a bifurcation between, good companies are getting really high valuations, and I think it's harder to get a really good valuation if you're not a really good company today. But those are sort of the outsized. When I say really good, I mean sort of outsized valuations. I think in general the whole market is pretty frothy, but we do definitely see companies that are growing 20% versus companies growing 100%, being bifurcated on that valuations spectrum. There's always somebody else around the table, and even if you're in an opportunity to preempt and sort of have a proprietary deal of some sort, it's still a matter of paying up. So there's no discount really today for getting there first. I think the market's so efficient. There's so much information out there. There's so many more deals that have been happening, and people have brothers or sisters or neighbors that have done transactions, that there's a lot of flow of information. And so that means, people are pretty sophisticated today on value and what they think their companies are worth. And many of the later stage entrepreneurs that don't have to raise capital they might have a valuation number in their head, and some of it's psychology. They may know their company's not really worth that number today, but that's the only number they're willing to transact at. They're also okay perhaps growing into that valuation, right? So that's the number, whether it's today or 2 years from now. For us, it might feel better 2 years from now than today. I do feel like there's more progress in probably the last 12 months than there's been in the last 12 years. And it's been obviously because there's been more discussion around it. And I feel like this actually happened kind of in the 90s in investment banking. There were, a few lawsuits and cases, and so there was discussion around it, and you saw the analyst classes in the 90s start to go to sort of 60-40 and then 50-50. And so I think that had impact in investment banking. It's too bad that it's been so many years before it's hitting the private equity and venture capital space, but I think we're here now, which is great. I do think that there's concerted efforts at all firms to seek more diversification across gender and race and everything, and very much an interest to be inclusive. And I think it's important from also the entrepreneur perspective, because we want to recruit the best and brightest entrepreneurs, and their companies. And so it's important to make sure that we align with whatever their, background might be as well. And so having the opportunity for us, I think at Norwest, we've invested in a lot of women-related products and businesses. And we've done that having women partners at the firm. And I think it's given us a good perspective, but also the ability to win deals.